The stock market's falling a lot. Hi, I'm Kevin Castaneda, and this is Kev's Mindset. And today we're going to be talking a little bit over what's going on in the market, especially in software and higher valuation stocks, tech stocks, why they're dropping so hard, why we see a lot of the fintechs dropping so much, just basically what's going on in the market and what to do about it. So before you do start, I would love if you could go ahead and smash that like button as well as subscribe if you do want to watch more of my content in the future. Now, without any further ado, let's get straight into it. So if you hold any tech stocks, fintechs, higher valuation software, you felt some pain today. If you held the S&P, NASDAQ, or more so index funds, you probably didn't even notice anything happened, because what we're seeing in the market right now is small caps have fallen like crazy from highs, have fallen like crazy from IPOs if they're newer companies, and we've seen large caps like big tech, for example, Apple, Microsoft, Google, Amazon, they've all kind of rallied, especially Apple, just kind of trotting along as nothing's going on. And then we see the higher valuation companies sell down quite a bit. We see things like Affirm, which is one of my favorites. It's a buy now, pay later company. They have several problems in a market like this. They are, one, not currently profitable. Two, they they have a higher valuation. So when you look at a company like this, it's like, okay, yeah, I think it's a great company and I think it's a great investment. But the market, what essentially happens is right now we have, let's say, so basically the Fed was printing a lot of money. This gave kind of funny money and play money for the economy to use. Now they've kind of started to cut that back, and instead they're selling bonds. Selling bonds increases the yield on bonds. Now banks are the ones receiving these, and then banks have been going up like crazy today. You see things like JP Morgan, several Goldman Sachs, several other banks, like especially the legacy banks, going up and up and up anywhere from 3 to 5%, which is pretty big move for a bank stock. And then you see things like recovery stocks starting to go back up now that we're getting better news about Omicron and getting just better news in general about society kind of reopening and everything. So when we start to see these things, we see those companies move up, and what happens is there's a lot of systems that especially Wall Street and hedge funds and bigger investor and institutions have, where it's not about the company. It's not about the fundamentals. It's not about, is this company doing great? Is their revenue growing? Is their bottom line growing? It's simply about, okay, what's up right now? What's down right now? And, bond yields are up, and then it immediately sells out of a lot of higher end tech, type stocks. And so when we look at these companies, we're like, okay, do we think that there's anything flawed with these businesses? No. And that's where it becomes really important that if you're invested in a business, you understand that business 100%. You have high conviction in that business. You are willing to invest long term in that business. You see the vision of that company. If you're not able to do all these things, then okay, a day like today comes where you're down anywhere from 3 to 15%, if you're in a stock like Affirm. And if you're down that much in a single day, you're going to be like, wow, the stock market's rigged. Wow, this company's terrible. And then you're going to probably sell out for a loss. But if you're invested in companies that you love, if you're invested in companies that you have high conviction about, you can hold through these tough and painful moments and be like, okay, it's going to be all right, because these companies are great companies and I'm happy to have them in my portfolio. Like today, Enphase was down around 5-6%. Affirm was down about 10%, or it was down 8%. And then I was like, this is crazy. I need to buy the dip. So I buy the dip. Then it breaks that $90 range. And I'm like, this is insane. It keeps dropping. I buy a huge chunk again at 87. And then it just falls all the way to 81. And at that point, I was out of cash and I'm looking at the market like, wow, this is crazy. And I love Affirm and I think it's a great company. I also see things like Nvidia dropped 5%. They're all great, incredible businesses that I think are going to thrive over the long term. So the most important thing to take in today is, yeah, nothing really happened with your companies. You're like all of them, they didn't all of a sudden have terrible financials. They didn't all of a sudden stop doing business. All that happens is the market reacts the way it wants to react, especially with big institutions, people moving a lot of money. They react in different ways. So the most important thing for you to remember is know your companies and make sure that you're happy and you have high conviction in these companies, because the market can react rationally like it did today. And honestly, this is not financial advice, but buy the dip, That's definitely what I've been doing in companies that I love. You have to look at them, and although it really sucks to look at your portfolio and watch it drop 3, 4, 5, 6, 7, 8, 9, 10% in a day, it's important for you to realize, hey, I like these companies for the long term and I want to be in them. So that's all I have for you guys today. If you did enjoy, smash the like button, as I would very much appreciate it. Also, go ahead and subscribe if you do want to watch more of my content in the future. If you haven't started investing yet, and well, you wouldn't probably be here. But if you want a new brokerage, you can sign up with Public down below and get some free money and out of free stocks just for signing up. So go ahead and do that. I'll see you in the next one. This was Kev's Mindset. Thank you so much for watching.